Well, here we go again. As soon as we hear rumblings that the United States and China are not close to getting their phase one portion of their trade deal done in December, the stock market starts crumbling. Now, of course, if you've been watching these videos here over the last couple of months, that should come as no surprise, as we've been telling you time and time again that the near-term bullish run that we were on was extended much longer than typical near-term bullish runs. In fact, we were at this 30 or 31 days for a while there, and typically they only last for about 15 days. So a pullback was inevitable. We're getting one now. We'll have to see once the smoke clears where that leaves us from a posture perspective. The last I checked, we still have a lot of upward trending moving averages out there, so I don't think we're going to give up on this market quite yet. In fact, there were a number of stocks that closed higher today, and in our trade application example, I want to show you one heavily shorted name that is a highly controversial stock that actually looks like it's setting up for a nice bounce going forward. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's December 3rd, 2019. Thanks for joining me here today. If you are new, remember to go to our YouTube channel, click subscribe. While you're over there, check out our description area so you can sign up for our email distribution list. In addition to that, we're heavy users of Twitter. Feel free to follow me at Brandon Van Zee. And lastly, we do have a presence on Facebook as well. Feel free to join our group at the web address embedded in the logo in front of you. All right, with that, let's go ahead and jump into the Thinkorswim platform. As you can see, I've got a slightly different view pulled up here. Just wanted to kind of give you a sense of the day's action here through a slightly different view than I normally have. And what I'm looking at here is on the Thinkorswim platform in the Market Watch area, rather than going to quotes, which is the typical default setting, go to visualize instead. And within the visualization area, I've pulled up the index watch, and within the watch list itself, I pulled up the public S&P 500 watch list. As you can see, today there were 135 stocks that advanced or were higher, and there were 364 that were lower or in the red. So it was about a 3-to-1 type of a day where the bears were certainly the storyline, but it wasn't a complete wipeout. Remember, we've seen kind of 9 and 10-to-1 types of days when there's some more annihilation out there, and that was not really what occurred here today. So again, I don't think this is a moment to lose our minds or anything along those lines. We still have a strong stock market that is much closer to all-time highs than to yearly lows, and we haven't broken major levels of support despite the selling of the last couple of days. Let's pop on over here to the charts now, kind of give you a lay of the land as far as where things set after today's selling. First of all, you'll recognize that the Dow Jones was down 1% here today. It was the laggard of all of our indices. All the other indices were down less than 1%. So S&P 500 was down 0.66%. The NASDAQ Composite was down 0.55%, and the Russell 2000 was down 0.31%. So all in all, it really wasn't a terrible experience. You'll notice here in particular, if you look at, let's say, the Russell 2000 and even the Dow Jones Industrial Average, you have some nice long lower shadows right there that tell you that the bulls didn't just roll over and die here. Yes, they were beat up in the battle early on, but by the end of the day, there was actually some buying that was taking place. And so I don't think this is a market that is destined to go straight down from here. Now, obviously, this is a market that remains highly sensitive to headline risk. And so if one thing leads to another and it appears that there's no chance of a trade deal anytime soon, then certainly we could see a stock market unwind. But unless we start seeing that more obvious headline, I think that the status quo right now is for the stock market to actually rise going into the end of the year, not the other way around. So we'll see where that leaves us. But what I can tell you right now is that from an intermediate posture perspective, remember that's kind of the default setting that we use during these presentations, unless you hear David and I say otherwise. When we say the posture is this or the posture is that, what we're referring to is the intermediate line on the market forecast technical indicator that you can pull up on Thinkorswim itself. And so that is the green line for those of you that are more familiar with the color scheme itself. So in this case, the intermediate / green line is at 88.25 and falling. Anything above 80 we consider to be the upper reversal zone, and therefore it's bullish whether it's rising or falling. And as you can see, we've been in the upper reversal zone since going all the way back here to mid-October. So it's been a nice, strong run that we've had. Now you will notice we had a little bit of warning sign here in the last couple of weeks. You're going to see a couple of red dots appear on this chart. And that signifies times when we had what was known as a overbought cluster signal, or some of you might still refer to it as a bearish cluster signal. Let me right click on this chart and go to maximize sell so that way you guys can see this a little bit better. These two red dots up here are associated with these two red dots down here. And they're trying to point out visually where we've had a cluster signal. And a cluster signal is when the red, the blue, and the green line are all in either the upper reversal zone or the lower reversal zone on the same day. I don't actually have any oversold cluster signals to show you on a 3-month chart here, but let me see if I can go back perhaps to a longer time period here, and maybe we'll be able to do that. So let's go back to maybe, let's see if 6 months will get us done there. And fortunately, that's not the case. So let's go to 1 year. And here I can give you an example of that. Right here, there was a green dot, right? And this was the last day of May. This is May 31st here. On that day, you'll notice all three of those colored lines were in the lower reversal zone on the same day, and that is an oversold cluster signal. So sometimes markets can get a bit too extended in one direction or another, and they start producing these clusters, and oftentimes they are worth paying attention to. You know, just in the last year, you can see a big group of clusters that occurred around Christmas time last year. Those were oversold clusters that led to a market bounce. Eventually, the market got so hot that we had an overbought cluster signal here that led to a market decline, to a point where we got so oversold here that we got an oversold cluster that led to a market rally. And eventually that takes us to where we're at right now, where we've had a couple of those overbought cluster signals here within the last couple of weeks. We also had a bearish near-term divergence during that time period that we were making you aware of as well. So there were certainly clues out there that we were due for some sort of a pullback, and we are getting it right now. The question is, how steep is that decline going to be? What are the odds that we end up having a poor end to the market year, et cetera, et cetera? So that is always going to be difficult to assess, of course, since nobody has a crystal ball. But one thing I'll just throw out there as food for thought is, after this 2-day decline that we've had here, you'll notice we still have that green background color with that green line in the upper reversal zone, suggesting we have a bullish intermediate posture. We still have a green moving average line right here. And remember, this is color-coded for those of you that are premium members. This is color-coded to distinguish between a stock, or in this case an index, that's either priced above a rising moving average, priced below a falling moving average, or a mix of those things. And right now, price is still above a rising moving average, and therefore we continue to maintain this green moving average line going all the way back here to October 11th. Now you can see at one point during this day, we were down below that moving average. Had we closed there, this moving average would have started changing to a yellow color at that time. But as I mentioned in the intro, the bulls actually kind of pulled themselves up by their bootstraps and rallied the market by the end of the day. Now, granted, we were still down significantly, right? That was still a 0.66% move, and that's, you know, an above average type of a move. In fact, you can see here with the daily range label, it's orange today as opposed to blue. Remember, it turns orange when today's range is wider than the average true range. In other words, this was a more aggressive type of a day that we experienced here today. But the bulls were able to make sure that the bears didn't just completely destroy them, and the bulls were able to rally this market at the end of the day, take us quite a bit away from that upward rising moving average that we see right there. In fact, one time I was looking earlier in the day, we actually had a bullish intermediate confirmation signal as the red line was in the lower reversal zone. But by the end of the day, there was enough buying there that that red line popped out of that lower reversal zone. So we didn't end with that signal, but it did exist at one point earlier today. And remember, that's a buy the dips type of a mentality there. So those that were brave enough to buy the dips close to the bottom probably got a nice little reward as the bulls were buying to end the day right there. So I think there is still reason to expect some bullishness out of this market, despite, what kind of feels like a little bit more nerves that have entered into the marketplace in the last couple of days. Until we start breaking down significantly below that moving average, I'm going to assume that the path of least resistance continues to be to the upside. However, it's not going to be a one-way trip, right? This movement right here that I was kind of referencing before. So you can see down below, this near-term line popped above 50 right here. The near-term line is the blue line, for those of you that understand the colors more than the terminology. So that blue line right there, that was way back here on October 10th, went above the 50th percentile for the first time. Now notice, it stayed above that 50th percentile all the way until right here on November 20th. So that was more than a month. Typically, that does not happen. Usually that run is done within a couple of weeks. So by the time we were getting to the end of this run here, both David and I mentioned multiple occasions that, hey, we've kind of overstayed our welcome. Now, we want to be respectful towards trend because anything can happen in the market, and the trend is your friend until the end, that sort of thing. But at the same time, you start reducing your risk in the marketplace, perhaps putting on smaller position sizing, et cetera, et cetera. So, it's not entirely surprising to see the stock market pull back. We were overdue for a pullback, and we're getting it. Is it the end of the world? No, it's not. We still have an upward trending market that is intact at this moment in time. And of course, if that changes, David and I will be the first to tell you about it here in these videos, which is why we do them on a daily basis. Right now, I think it makes sense to keep a cool head on your shoulders. So at this moment in time, we continue to have bullish intermediate postures on all four of our indices. The one that is most at risk of losing its bullish posture right now is the Dow Jones Industrial Average. Of course, that was the one that was down over 1% today. Remember, the trade war news hits a lot of those big industrials like Caterpillar and Boeing and some of those companies that are in the Dow a bit more than your typical smaller company in the United States, because those types of Caterpillars and Boeings oftentimes want open borders, not closed off borders. So they would prefer to get this trade war out of the way and move on, but that is not what is happening right now. So the Dow Jones Industrial Average is the one that is most at risk of losing its bullish posture. And I say that because if you look at the reading within the green labels of all four of these charts right now, you'll see that it's the one that's closest to 80. So it's at 83.25 and falling right now in terms of that intermediate green line. If it were to fall below 80, it's at that moment where we have a weekly bearish posture. So if we have another couple of days of selling here in front of us, then the Dow Jones would likely be the first one that you'll see us report on that will go to a bearish posture. But we don't know if that's going to happen or not. Right now, we see largely the trends being held intact. Now, the other thing I'll point out about the Dow Jones is it is the only one out of these four that we see in front of us that has that yellow moving average right there. I mentioned before the S&P 500 does not have that because the bulls rallied it by the end of the day and closed it above the moving average. In the case of the Dow Jones, we did have that long lower shadow there as well, but unfortunately the bulls weren't strong enough to actually push it back above that moving average. So it closed below that rising moving average, which is why that 30-day moving average now has that yellow tip on it right there. So, from a couple different perspectives there, it appears that the Dow Jones is the one that's taking this trade news the worst at this moment in time. Let's take a look at a couple of other charts here. Let's move on to, how about the three green arrows chart, and that is chart 4D. All right, as we look at this, we do have something new to report, and that is, in this particular instance, the Dow Jones actually has a 3 red arrow signal. So, given what I just mentioned a moment ago, that's a pretty good segue into this conversation. The Dow Jones is the one that is probably the most sensitive to the trade war. It is the one that got beat up the most today. It is the one that is closest to risking its bullish posture on the market forecast. And now we can see yet another negative scenario developing here for the Dow, which is we have a 3 red arrow signal. We have price closing below the moving average, which generated that arrow right there. We have the MACD histogram trading below the zero line. That's been a red arrow going back here since November 20th. And then today on the stochastics indicator, remember the stochastics upper reversal zone is different than the market forecast. They're both oscillators, but they have slightly different rules. With the stochastic, the upper reversal zone is 75. So we've actually fallen below 75 here on the stochastic to generate that final red arrow there. That's telling you that the index is closing near the lows of the range more often than not here recently. So we actually have that 3 red arrow signal. And remember, on this chart 4D, you can see that very easily by just looking at the background color of the chart. It turned pink right there, letting us know that it now is in that 3 red arrow condition. The other 3 charts is a mix of red and green arrows. You can see the background color of all 3 of the other charts is white. And so it's got a mix. Notice that the Russell 2000 just gave up its 3 green arrow status today when the MACD histogram gave us this red arrow right here. It actually still has a green arrow on the moving average, and it still has a green arrow on the stochastic. So that appears to be the one that could kind of bounce back to a 3 green arrow status the quickest out of all of these indices here. And remember, a lot of those Russell 2000 types of stocks, they might be small banks, regional banks that, you know, for all intents and purposes, don't have a direct relationship with the trade war in China. And so you find that they're able to kind of withstand some of this headline risk a bit more than those big heavy industrials that rely upon free trade for their prospects going forward. So the Russell 2000 has kind of been a surprise stalwart here more recently, and that's generally considered a positive sign. Let's go ahead and take a look at a longer term view now, and this will be the 1040 crossover method, chart 4C here. And as you can see at this moment in time, from this particular perspective, we still have a bullish posture. Now remember, this is the least sensitive of all of these approaches that I've shared with you so far. We're looking at weekly candle charts here, and this is a 3-year chart in each of these cases. And we're looking at a 10-week moving average, represented by the orange line on the chart, and a 40-week moving average represented by the blue line on the chart. So if you're an active trader, this is probably going to feel a bit too slow for your liking. On the other hand, if you're somebody that has a 401k and you can't actively trade and you just kind of want to move in and out of the market with your mutual funds, then perhaps it's something to consider. The idea behind it is to try to catch the juiciest part of the trend and not sweat the small moves in between. Sometimes that'll work, sometimes it won't, just like anything in technical analysis, but you can kind of get the sense of why that can be a useful thought by looking at something like the Dow Jones over here. For much of the last 3 years, we've had that green shaded background color there, signifying that you would be better off being bullish than bearish in the marketplace. And therefore, you've made some decent gains in those trends along the way. Whereas the Russell 2000 has been a bit more of a choppy experience down below here, where you've seen kind of the posture changes from pink to green a little bit more actively there. So anyway, as it stands right now, it's all systems go with these particular charts, but as always, we'll keep you informed if anything changes from that perspective as well. All right, let's get into some 12 grid analysis now, starting with chart 5A. And as a reminder, when we look at these 12 grids here, the background colors of the charts will tell you whether we have a bullish posture or a bearish posture, with of course a green background being bullish and a pink background being bearish. Now we take it a step further by signifying a slight difference in the shading of green and pink. Some of them will be a heavier color, some of them will be a lighter color. So let's use the S&P 500 in the upper left as a good example. It has that dark green background color here still at this moment in time, telling us we have a strongly bullish intermediate posture on the US stock market. Whereas down below, let's look at real estate over here to the right. VNQ has that light green shading behind it, telling us that we have a weekly bullish posture, not in terms of time, but in terms of strength, strong versus weak. So this is a weekly bullish posture right here. Its line is at 44 and rising. Remember, we distinguished that by the 50th percentile. So if this were 51 and rising, we would call this a strongly bullish posture. But because it's not above 50, it's only at 44, we are still kind of in the infancy of that move, and it's hard to trust it at this point, especially in this particular case where price is still below a falling moving average. So anyway, that distinguishes between the dark and the light on the bullish side, and then it's kind of the opposite mindset with the pink chart. So down below here, you'll notice the TNX. This is the 10-year U.S. Treasury yield. It closed lower by a dramatic amount today. I guess I didn't even realize that that was the case until now, but boy, that was a big move there. Look at that candle on TNX. It's an aggressive move lower. And remember, when interest rates are falling, in this case, they fell down to 1.71% on the 10-year. When they fall, typically that means good things for bonds, utilities, and REITs. And so it shouldn't be a surprise that VNQ, which tracks the REITs, was up today. So that entire class of stocks was higher today. It was up 0.64. It's actually a pretty decent day. Same thing can be said over here for bonds. Long-term U.S. Treasuries had a very nice day. It was up 2% today. Interesting movements there from an interest rate perspective. But that dark pink background there on TNX reminds us that this is a strongly bearish posture, because the intermediate line is below 50 and falling. So in this case, it's at 30.96 and falling, strongly bearish posture. Whereas the chart just to the left of it, oil prices, it's got that lighter pink background there, which suggests a bearish posture, but it's not a strongly bearish posture, it's a weakly bearish posture. In this case, you can see the line is at 69 and falling, so since that number is above 50, we would only consider that weakly bearish at this point. So, interesting movements here today. I'd say that the big story, the big takeaway here is that interest rates fell significantly, and that oftentimes does happen on days when the stock market has an above average sell-off as well, as there's a little bit more of a kind of a risk-off mindset there, and investors pile back into bonds and out of stocks. Well, when investors pile into bonds, the inverse is true with the relationship with yields. Yields go down when bonds go up and vice versa. So anyway, that's probably the big storyline here from an asset class perspective. Interest rates really got dinged up here today. Let me pull up the VIX as well. The VIX was a pretty big story in the market today, at least if you were to pull up Twitter. It seemed like a lot of people were talking about the VIX today. As you can see down below, and let me kind of right click and maximize this chart, the VIX is kind of shot out of a cannon here. And remember, that's fairly typical for the VIX. The VIX is not like other charts where you see predictable patterns. You basically see a chart that grinds lower when the stock market is behaving itself, and then it appears like it's shot out of a cannon when the stock market starts stumbling aggressively. And that's what has happened here in the last couple of days. Now, similar to what I was mentioning with the long lower shadows on the stock market charts, notice that we have a long upper shadow here on the VIX chart. That would be considered slightly bearish. Now, obviously, it was still an aggressively up day for the VIX. It was up 7% today, and we closed at around 16 on the VIX. And remember, that's still historically quite low, so we can go a lot higher. In fact, in the crisis, we went all the way up to 90 on the VIX. So this is like an afterthought compared to that. But one thing to be aware of is that after the VIX rallies hard, it usually unwinds equally as quickly. So you've got to be really nimble and mobile with your trading if you want to kind of try to take advantage of that. So for those of you that are premium sellers, hopefully you got an opportunity earlier today. When the VIX was all the way up here, I know it was above 17 at one point, you might have been able to get some nice premium for those options that you were selling out there. But you'll have to pay attention to that long upper shadow in the case of the VIX. That generally is a sign that the fear was not as aggressive at the end of the day as it was on an intraday basis. All right, let's go ahead and take a look at another 12 grid now. In this case, let's go on over here to chart 5C. And this is the U.S. sectors 12 grid. All right, so as you can see, we've got a little bit of an interesting pattern developing here. Now, I've structured this particular 12 grid for a reason. I don't know if you guys noticed that or not, but it kind of matches the business cycle, so to speak, and also the stock market cycle, so to speak. This might be useful if we come over here just briefly and look at the sector selector and talk about it at the same time. I kind of have this cycle embedded within my logo for the sector selector itself, and it kind of shows you what the stock market cycle is versus the business cycle itself. While we're over here, let's just have a quick chat about any movements we saw in the most recent sector selector. One thing that did catch my eye, especially after the last couple of days, is that technology fell from number 1 the prior week to number 4 as of this last Friday. So remember, I produce this on Fridays. I have no idea what's going to happen on Monday or Tuesday of the following week. So I produce it, and it is what it is, right? It doesn't lie. It's based upon what are the movements, what are the different technical indicators. I rank this by 10 different technical indicators out there. So it's a pretty comprehensive way to look at sector rotation. So I didn't really think much of it on Friday other than, that's kind of strange that technology went from number 1 to number 4. Usually you don't see a big drop off like that out of the blue unless there was something very obvious kind of happening. I didn't really recognize anything major happening last week. It was kind of a quiet week with Thanksgiving and everything else. So I didn't really think much of it. But after the first 2 days of this week, where we've seen a lot of technology stocks really falling apart, maybe this gave us a little bit of a heads up on Friday that, hey, the technology area may not be quite as strong as initially thought. There might be a few things brewing below the surface that is not entirely obvious by just looking merely at price. And so it gave us a nice little heads up there as of Friday that technology was starting to fall a little bit out of favor again. On the other hand, industrials, healthcare, and financials were the number 1, number 2, and number 3. And in particular, healthcare has impressed me. You can see that if you track your eyes back with this blue line over time, this is the last 3 months here, this is the highest healthcare has been on this graphic going back over the last 3 months at a minimum. And so it's been a while since we've seen healthcare kind of being a leadership group within this market. And many of you might be recognizing, if you watch CNBC in the morning or even just look at my 9 at 9 graphic on Twitter or on our website, that it seems like more often than not recently, we've had a lot of biotech stocks that have really been kind of topping the charts. And so biotech has gotten really, really hot here recently. I'd also say that healthcare supplies have gotten quite hot here recently. We had that conversation yesterday in my top-down trend trading class, as we had 2 of our candidates that we were reviewing as a class coming from that area. So not necessarily the biotech area itself, but the companies that supply the biotech companies. So anyway, keep your eye on healthcare. That's an area that does seem to be surging that really wasn't showing us much of anything in prior months. Most of the other rankings, by the way, stayed the same. So I'll rank this upcoming Friday, and we'll see if things change there. But otherwise, it was a reasonably quiet week in terms of sector rotation there outside of what I mentioned with technology there. While I'm over on the internet, did want to say thank you to everybody who clicked like for me the last time I did this video. Remember, that helps us get this word out about our business out to others. It takes David and I about 2 or 3 hours to produce these YouTube videos every day with all of the editing and notifications and research and everything that we got to do. And so one way you can say thank you to us is to click like for us on Twitter. I know not all of you are keen on doing that, but for those of you that are, we certainly appreciate that, and it helps remind us of why we do these videos. Remember, if everybody just stops clicking like all at once, we're going to make the assumption nobody really cares about these videos anymore, and we'll find better things to do with our time. So if you care about these videos and if you care about having them produced on a daily basis, make sure that you do your best to click like for both David and myself on a daily basis to remind us to produce these videos as often as possible. Now, another thing that I wanted to mention while we're over here is tomorrow I'm going to be talking about swing trading. And that is one of the few classes that I teach here at Market Scholars where we can be bearish with our thought processes. David has a little bit more opportunity given his subject matter expertise. I'm more on the long-term investing side of the equation where we don't do a whole lot of bearish trading, but I do have one exception to that is my swing trading class. So if you're interested in learning how to not only buy stocks off of bounces, but also short sell stocks off of bounces, then join me tomorrow, 11 a.m. Eastern Time, if you are a premium member of Market Scholars. In fact, we have quite the win rate going in that class this year, 70% win rate on a one-for-one risk-reward relationship. So we've done incredibly well. I'm super proud of those students in that class. Remember, we take a collective intelligence gathering approach in all of my classes where we basically bring together dozens of traders And we all vote democratically upon which should be the best trade there. So if you kind of like that idea of getting others' input on the trades that you're looking at, then that could be something of interest to you. And also, David will be teaching his options inventory class tomorrow for premium members at 2 p.m. Eastern time. So I'm sure he'll have lots to say there with the nice hike in the VIX that we saw here today. And earlier today, I taught my dividend growth investing class. We covered the industrial space. That is now posted. And David had his directional options class. So lots of stuff there to sink your teeth into. Let's go ahead and get back on track here with our charts now. So the pattern that I was mentioning before is that in the middle here, we have all these pink charts. On the top rung, we have green, and on the bottom rung, we have green. The pink part in the middle there is considered to be the more heavy cyclical sectors that are out there. You know, the stuff that if you drop it on your foot, it hurts, right? If you think about discretionary stocks, you might think of like Ford and GM. You drop a car on your foot, it's going to hurt. Industrials, Caterpillar and John Deere. You drop those on your foot, it's going to hurt. Materials, you drop a bunch of steel on your foot, it's going to hurt. Energy, you drop a barrel of oil on your foot, it's going to hurt. So it's kind of the stuff that really does well when the economy is firing on all cylinders. Whereas those other areas there, you're going to find to be a little bit softer, not quite as hard, and can do better in other types of market environments. In fact, that bottom rung there is known as more of the defensive areas of the market with healthcare, staples, utilities, and real estate. And you can see all of those have green charts right now. I mentioned healthcare before. It has a strongly bullish posture. And you'll see that it was only down 0.22% today despite rallying strongly in recent weeks. You can see the staples also have a strongly bullish posture here, and it was only down 0.16% today. The utilities and REITs both have weekly bullish postures, but both of those were up today. And a lot of that is, again, back to what I mentioned before. Interest rates fell significantly today, so no surprise. Utilities and REITs actually both finished in the green today. Now, they weren't alone. There was one other area that I thought was pretty interesting, and that was a highly shorted stock that was up today. And let me pull up chart. Let's do chart 3A for this. This is a controversial name. Some of you are big fans of this company. Some of you detest this company. It is Tesla. It is one of the most, it attracts the most bipolar trading out there. Some people absolutely love it. Some people say it's a fraud and it's just ready to go to zero. Well, I'm not ready to make one claim or another here today. All I'm going to do is identify a possible trade setup. As you can see, Tesla was actually up today. Now think about that. Today was one of the worst stock market days we've had in over a month. On a day like today, you would think that a aggressive stock like Tesla would be down, and instead utilities and REITs and other defensives would be up. But instead, what we found was that Tesla was actually up. It was up 0.4% today on a day when the stock market got beat up. And so sometimes you can look at stuff like that and wonder to yourself, is that a tell? You know, for those of you that play poker, you know, what is the tell? Sometimes when a stock that is considered to be highly risky and volatile is up on a massively down day, it's the markets tell that that stock is more likely to rise in the future than to fall. And as you can see, we're actually rounding out a nice little bottom right here after kind of falling on this stock from November 20th to about November 29th here. But now the last 2 days, we've actually rallied. So while the stock market has gone down the last 2 days, Tesla has gone up for the last 2 days. What I like about this chart is that it's stabilizing right around that upward trending 30-day moving average as well. Now, you'll also notice that the S&P 500, which is kind of this dotted gold line down below, is showing us that the stock market is lagging Tesla significantly over the last 3 months. This stock is up 52% over the last 3 months. So I get the sense that there are a lot of trapped shorts in this name. Seems like, you know, this is one of the most widely recognized shorting opportunities out there, as a lot of people feel that Tesla is worth nothing. And some shorts are determined to ride this to zero. Now, along the way, there's going to be a lot of, you know, indigestion in the marketplace, even if you ultimately are right with that thesis. And if too many people pile on the short bandwagon, it can create a short squeeze. And that is possibly what has taken place here in Tesla in recent months. Of course, we also had the big product announcement with its Cybertruck that is kind of fueling some more excitement in the marketplace as well. So anyway, I kind of like this one from the tell perspective, and also from the fact that it's bouncing up and away from that rising 30-day moving average. And from a swing trading perspective here, you can see that we do have a bullish posture at this moment in time as well, with the rally that we've had in the last couple of days here. So what I thought we would do today is sell a bull put spread on Tesla, and I've already got the trade pulled up here over on the trade tab. The one that I'm going to do is going out to the January monthly contracts with 45 days until expiration, and I'm going to sell the 305 put, and I'm going to buy the 300 put, and that's going to create a credit of $1.14, which is right at your 30% return on risk. And so what we are hoping to accomplish here, for those of you that are not as familiar with selling a bull put spread, is we want this stock that is currently priced at $336 to stay above $305 for the next 45 days. So in other words, we have a $31 head start here. So as long as we're not wrong by $31, we stand a good chance to make some money on this trade. Now, if you click on confirm and send, you'll notice that your break even is, right around 303.86. And if you look at the chart, 303.86 would be approximately right here where I'm circling. So in other words, this stock would have to fall dramatically below that rising moving average for us to start losing money on this trade. Now, can that happen? Of course. This is a very speculative stock. It can go up and down dramatically in any moment in time for any reason. So it's certainly not a home run. No trades are, but I think it does provide an adequate amount of safety considering the circumstances that we have out there. And the other thing that you kind of have as an ace up your sleeve with this particular chart is you'll notice that we had this big gap up that took place over here after earnings, and it is thought that gaps will hold until they don't. In other words, there will be bulls that are buying this stock to try to hold this gap and try to make sure that this candle's low price does not get breached over here at around $290. So that should help protect this trade to a degree as well. So with that, I'm going to go ahead and click confirm and send, and we'll ship that off to the marketplace and see if we can get filled first thing in the morning. All right, well, thank you for joining me here today. It was an interesting day in the stock market. Obviously, we were in the red for most of the indices out there. However, there were some nice bright patches out there, whether you're looking at the REITs or the utilities, or even a few of those speculative stocks like Tesla. So not all was lost today. We remain above a rising moving average. So we'll continue to monitor it going forward. But as of right now, we still lean a little bit more bullish than bearish, and we've been waiting for this mini pullback that we are currently in the midst of right now. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.